All right, lights, camera, action, we're on.
Hey, by the way, you know what, I have posted, I think I'm kind of posting these things up on YouTube, they're all there. Have you guys heard any interesting conversations that this picked up or on this? All right, I'm just curious. All right, so let's do this. And again, all right, you guys ready? Yes.
No,
All right.
I'm not.
You're not? Okay,
I need something. I need to.
all right. Okay, let's, should we go ahead and get started?
Okay.
All right, and you guys do give me your, okay, that's Tim that's talking, right? Oh, never mind, all right, sorry, okay. Somebody up there was. Anyway, listen, which of the following would not be included in the cost of land? Paving's not, land and paving are in two different depreciation schedules. Land is one thing, land improvements and paving, all that's another. Okay, which of the following would not be debited to machinery, electricity, so don't forget, every asset is valued at what you pay for it plus whatever it costs to get it in working order. So the installation cost would be part of the cost of the asset, freight charges, trial runs, all of that. Electricity, no. Okay, but anything that is needed to get it in working order. The portion of a group purchase of $640,000 allocated to land when the land is appraised, so is 170 and the building is appraised at 510. So here's how this works, okay? So in this case, we have 510. That's one of that's the appraisal for the land, and that's the appraisal for the that's appraisal for the land, okay? 170 is the building. You add those together, it comes to 680. Now, what they want, the portion, so what they want is how much is allocated to the land. Well, it turns out to be these two, so let's just turn that into a fraction, multiply that times the 640, and it comes to 160. So here's the value of the land. See, this is the value of the land.
That's the building.
Oh, I see. I said, here's the land is appraised at 170, the building's 510, so the total appraisal is 680,000. What they want is the value of the land, and so we'll just turn this into a fraction, multiply it times the cost, and that comes to 160. You guys okay with that? You want more of an explanation? Okay. All right, okay. In general, a cost incurred in conjunction with a long-term asset is included in the long-term asset when the cost is incurred prior to the asset's use. So whatever it costs to buy it and get it in working order, that would be in general prior to its use. It is necessary to distinguish between capital and revenue expenditures. Because of which of the following accounting principles? The answer is the matching principle. Because what you want to do is, for example, if you have an extraordinary repair, that extraordinary repair will be used up, will extend the life of the asset, and it will be used up in future accounting periods. So you want that expense to show up in future accounting principles. So the matching principle is your concern. If it's a revenue expenditure, that means it'll be used up in this accounting period. For example, if you change the oil in a car, that's a revenue expenditure, it's a period expense because it doesn't last long. If you put a new motor in a car, that's a capital expenditure because that motor will be used up over future accounting periods. Okay? So it's the matching principle that you're worried about. And an extraordinary repair like a new motor will extend the life of the asset. Okay, all right. And of course, what you want to do is you want to match the expense to the revenue it produces. All of the following are needed for the computation of depreciation except the actual price. So, you know, for instance, you need the cost minus the residual value. That will give you the depreciable cost divided by the useful life. That will give you the amount of depreciation per accounting period. The actual disposal cost doesn't come into play in computing depreciation. Now, when you actually sell it, then there may be a reconciling you have to do because your depreciation was an estimate. The depreciable cost is the cost minus residual value. In other words, the depreciable cost is how much you expect to use up. Okay? All right. Okay, all right. So, the salvage value is not the same as the carrying value. So the salvage value is the same as residual value, disposal value, scrap value. Carrying value is book value, and it's how much is left to be expensed. Okay, so it's cost minus, it's the value of the asset minus accumulated depreciation. That's the carrying value. It's how much has yet to be expensed. Office furniture is purchased for $26,000. It has an estimated residual value of $4,000 and incurred carrying value of $8,000. The depreciable cost is. So the depreciable cost is so is the cost, the $26,000. You guys, be sure to give me your attention. You got a question, I'd be glad to answer it. Sound good? So this is the cost minus the residual value, the salvage value. Okay. So that means there's $22,000 of depreciable cost. And of course, depreciable cost is how much you expect, how much expense you expect to incur over the life of the asset. Okay? Okay. And it's cost minus salvage value or residual value. Okay? The next one then says, if an asset costs $25,000 and has a residual value of $250,000 and a useful life of 5 years, the depreciation in the second year using the double declining. So don't forget, double declining is different than the other two. It doesn't deal with depreciable cost. Rather, it takes the book value times twice the straight line rate. Okay? So here's the way this works is, it will be $25,000, that's its book value the first year, that's what you pay for it, times 40%. Everybody okay with the 40%? Okay, because if it's 5 years, that'll be 1/5, that'll be 20%, so it's twice that, so it'll be 40%. Who wants an explanation of the 40%? Good, all right. So that means the depreciation in the first year will be $10,000.
Steve,
Yep.
you had one person that said they want that.
Oh, good, I missed that. Who said that? Oh, Carolyn? That was you. That was you, all right. Yeah, here's what you do, is, in other words, what it is, and thank you. So in other words, it's 5 years, so that's, you divide 5, what it is, the way the book does it, is you take 100% and you divide it by its useful life, that comes out to be 20%, and you multiply that times 2 for 40%. This is the way the book does it. So it's 100% divided by the number of years of useful life, so 5 into 100 will go 20 times, okay? And then it's twice that for 40%. Okay? All right. Then, in the second year, so now, we have 25 minus 10, so now the book value at the beginning of the second year is 15,000. So this is the book value, right? Because it was 25, it lost 10, so now it's down to 15. We multiply that times 40%, and the depreciation for the next year is $6,000. Okay? And that's what they asked for. What's the depreciation for the second year? It's $6,000. Does that make sense? So it's the book value times twice the straight line rate. Sound good? All right. The next one is, use the information below to answer the following questions. A truck is purchased for $35,000. It's a 5-year life and 5 years residual life. Under the straight line method, what is the assets value carrying after 3 years? Well, if it's straight line, it'll be the same amount every year. So you multiply the depreciation times 3, and then subtract it from the 35,000. So here's how it works out. It will be 35,000 minus, here's the depreciable cost, 30,000, divided by 5, multiply that times 3, so this is the depreciation per year, okay? That comes out to 17,000. Okay. Does that make sense? Could you ask me if you got a question?
Yeah.
Thank you much, yeah, I appreciate that, Angelica.
So, is Angelica,
I'm not trying to digest that, I don't understand.
Angelica, you go, that's the $35,000 that's purchased for, and then you figure out the straight line, so it has a salvage value of 5,000.
It's right, 35 minus 5.
Hey, listen, let me go ahead and
Divided
answer this
by
thing.
five.
Okay, Eric, you want to wind this up, but let me answer them in the future. Sound good? Good. Go ahead if you
Okay,
like.
so divided by 5,
Okay, yeah.
and then you get the year, so every year it's 6,000.
Right, so 6 and 3 is 18,
Uh-huh.
then you have 17.
35
No,
minus
you
18.
might-
Here you go, depreciation.
Oh, I got it.
All right,
The next step, okay. So then you do 35 minus the 18.
okay. All right, you guys doing good okay now? Okay. Now, under the double declining balance method, what is the accumulated depreciation after 2 years? Okay, so, in this case, it'll be 35,000 times 40%. That comes out to be 14,000. So in other words, here's the book value at the beginning of the first year, twice the straight line rate, depreciation for the first year. So who has a question on that? Okay. Now, 35 minus 14, the book value at the beginning of the next year is 21, twice the straight line rate is 40%. The depreciation for that year will be 8,400. And the accumulated depreciation will be adding those two together, which comes to 22,400. Does that sound good? Okay. All right, the next one. The sale of equipment costing $40,000 and the sale and a sale price of $8,000 would result in. So it costs $40,000. Accumulated depreciation is $34,000. So what you do on this thing is you determine the book value and compare the book value to the sale price. If the book value is greater, it'll be a loss. If the book value is less, it'll be a gain. Now, in this case, what we have is the cost is $40,000. Okay, so $40,000 is the cost. We subtract the accumulated depreciation of 34,000, and I'm going to just abbreviate here, accumulated depreciation. That means the book value is $6,000. Now, in this case, they sold it for more than that. So they sold it for $8,000, which is the cash. That means there's a $2,000 gain. So what you do in this case is you determine the book value, and you compare it to the cash. If the cash is greater, it's a gain. And if the cash was less, it would be a loss. Does that sound pretty good? All right. Should we go to the next one? Porter Mining Company purchased a gravel pit for $2,500,000. Estimates that 5 million tons of gravel can be extracted over the pit's useful life. If 1 million tons are extracted and sold during the first year, how much depletion expense should be reported? All right, so you figure the cost per ton when you bought it and multiply that by the number of tons extracted. So in this case, what we have here is so they spent $2,500,000. They bought 5 million tons of ore. That means that every ton, where they pay 50 cents per ton. Then they extracted 1 million tons. So we're going to multiply this out. So that means the depletion expense was 500,000. So here's how much they paid per ton, the number of tons were extracted, This will be the depletion expense. That sound pretty good? All right. The next one then is a company purchased a delivery van for $23,000, okay, with a salvage value of $3,000 on September 1st, year one. It has an estimated useful life of 5 years. Using the straight line method, how much depreciation expense should they recognize December 31st, year one? So they owned it all of September, October, November, December, so they owned it for 4 months. So it's the, you want to figure out the total years depreciation and then multiply it times 4/12. Does that sound like a plan? So in this case, it will be the cost minus the salvage value divided by its useful life. That will give you 1 year's depreciation. Then we're going to multiply that times 4/12 because we only own it for 4 to 12 months. That means the depreciation will be 1,333. Item B. Does that sound good? All right. The next one is Phil Phoenix is paid monthly. For the month of January of the current year, he earned $8,288. The FICA tax rate for Social Security is 6.2%, and the FICA tax rate for Medicare is 1.5%. The FUTA tax rate is 0.8%, and the SUTA rate is 5.4%. Both unemployment taxes apply to the first 7,000 of employees paid. The amount of federal income tax withheld from your earnings was $1,375.17. What is the total taxes withheld from Phoenix's wages? Okay, so is the gross wages times 6.2%, that will give you the Social Security, and that comes out to 513.86. Now, gross wages times the Medicare tax of 1.45% means that $120.18 Medicare was held out, so we're going to add those two together, plus the income tax of $1,375.17. So the total taxes withheld is $209,000.21. That sound pretty good? Okay with that? Okay. And again, don't forget, FUTA and SUTA are only paid by the employer, and it asks for the employee's withholding. So Phil is not affected by that. Okay, you guys okay? All right, an employee earned $62,500 for an employer. Okay, the FICA tax rate for Social Security is 6.2%. The FICA tax for Medicare is 1.45%. The current FUTA tax rate is 0.8%, and the SUTA tax rate is 5.4%. Both unemployment tax are applied to the first 7,000 employees. What is the total unemployment taxes paid by the employee? 0. It's just as before. The employer is the only one who pays SUTA and FUTA. The unemployment taxes are SUTA and FUTA, right? And what they do is they fund unemployment compensation, right? Okay, and only the employer pays that. And the question says, how much of the FUTA and SUTA did the employer pay? Jim, I see kind of a quizzical, can I clear up anything for you?
I just remember from the quiz, I got it wrong twice because I was just reading it too fast, how much the employees pay, and it was 0. I just remembering that.
And you gotta be,
You gotta be careful reading it, and I struggled with that.
I sure could have done that. Yeah. By the way, you know, something that's helpful is we underline as you go along.
Yeah.
And of course, that's a good way to do it. Justin?
I forget, which one is the one that the employer matches?
Both of these, the employer matches the FICA, Social Security, and FICA Medicare.
Okay.
The employer matches those.
Alright.
The employer only pays FUTA and SUTA, and the employee only pays income tax withholding. Okay. All right. A company sold $12,000 worth of trampolines with an extended warranty. It's estimated that 2% of these sales will result in the warranty work. The company you recognize the warranty expense and liability in the year of the sale. So what it is the warranty, you offer a warranty to increase sales, and you want to match the warranty, and warranty, there's no free lunch, there's an expense to that. And so you match that expense to the revenue produced, you just put in the same accounting period. Okay, you can do it at the same time, do it as an adjustment, but it just has to go in the same accounting period. All right? On March 17th, Brady Company agrees to accept a 60-day, 10%, $45,000 note, okay, note from the Albert Company to extend the due date of an overdue account. What is the journal entry needed to record the transaction by the company? So in this case, it's accounts payable. So you debit accounts payable and credit notes payable. So what you're doing on this thing is you're moving it out of accounts payable into notes payable. And so your supplier now has a note payable, and a note payable is easier to collect. Does that sound good? All right? And so just a couple things. Don't forget, interest equals principal times rate times time, right? And maturity value equals principal plus interest. Okay? So that's the maturity value, principal plus interest, and the interest is principal times rate times time. I better slow down and make sure that it's more legible. You guys doing okay with that?
Yeah.
Okay? I probably only need to jog your memory, actually. An employee earns $5,500 per month working for an employer. The FICA tax rate for Social Security is 6.2%. The FICA tax rate for Medicare is 1.45%. The current FLUTA tax rate is 0.8% and SUTA is 4.4%. Both unemployment taxes apply to the first 7,000 employees paid. The employee has $182 in federal income tax withheld. The employee has voluntary deductions for health insurance of $150 and contributes $75 to retirement plan. What is the amount the employer should record as payroll tax expense for the month? So don't forget what we're talking about here. So we're talking about the employer payroll taxes for the month. So in this case, the employer will pay both, will match the FICA Medicare and FICA Social Security. The employer will then in addition have FUTA and SUTA. So in this case, it'll be the gross amount, so it'll be $5,500 times 6.2%. That'll be the FICA Social Security, so that will cost the employer $341. Again, we have gross pay times 1.45%. So that means that 79.75, that will be the Social Security Medicare that the employer pays. And we have 55 times 0.008. Now why did I write 008? Because it's 0.8%, right? So 0.8% in decimal terms is 0.008. Okay, so that comes out to be $44. And we have 5,500 times 4.4%. That equals 242. So we got FUTA and SUTA. So we add all those together. And the total payroll taxes then comes to $706.75. Sound good? All right, any questions? Okay. Now, you gotta keep an eye on the time here. So, Arena Company salaried employees earn 2 weeks vacation per year, pays $858,000 in total employee salaries for 52 weeks. Good employees only work 50, record Arena's weekly payroll. All right. So if we take 858,000 and we divide it by 50, that's, they work 50 weeks. So actually, the amount they earn in a week is $17,160, okay, when they work. Now, we take 858,000 and we divide it by 52, but they're paid every week. So they're paid $16,500. So the difference of $660 is how much goes into the vacation fund, the vacation payable. That sound about right?
Mm-hmm.
So here's how much they actually earn per week, because this is their annual pay, and they work 50 weeks, but they're paid every week, so this is how much they're paid per week. The difference is the vacation pay. Does that sound good? All right. Okay, and also be sure to read these things carefully, darn it. Okay. The exclusive right to sell a computer program is called, it's the copyright of computer program. Okay. The disadvantage of the partnerships include, it does have limited life. 2 people are in a partnership, 1 dies, the partnership's over. Mutual agency, if your partner makes poor decisions, you can be obligated. Unlimited liability, so all partners are equally liable for all the debts of the business. And co-ownership of the property. You put the property in the partnership, it belongs to the partnership, so all of them are disadvantaged. Mutual agency says that a partner can commit or bind the partnership to any contract within the scope of the partnership's business. 25. Collins and Farina are forming a partnership. Collins is investing in a building that has a market value of $80,000. However, the building carries a $56,000 mortgage. That will be assumed by the partnership. Farina is investing $20,000 cash. The balance that Collins' capital account will be, well, it's the net. So if it's an $80,000 building, that's the building, and I'm going to BLDG as an abbreviation, and it has a $56,000 mortgage. The difference is $24,000. That's the net, and that is into the capital account. Does that make sense? Okay. It would also be, it would be building, BULD, building, would be debited for $80,000. Mortgage payable, I'll just put it in a different format, would be $56,000. Then, it would be Collins, comma, capital, and I'm going to abbreviate CAP, would be $24,000. So this says the same thing in a different format. Okay? But it's the net amount that goes into Collins' account.
I have a question.
Sure.
What, because when it says that it carries a $56,000 mortgage that will be assumed by the partnership, I assumed that it would be by the both of them, but you just subtract it from Collins?
Well, it says it's assumed by the partnership, so don't forget, go back up here. The property's co-owned, right? So once they put this building into the partnership, it's co-owned by the partnership, and then it goes on to say that the partnership also assumes the mortgage.
Okay, but you only subtracted it from Collins' account though. You didn't subtract the
Right,
mortgage.
because Collins is the guy who invested the building. And another way of wording this is how much is this investment worth?
Okay.
And the value of this investment is the building minus the mortgage.
Got
So that's how much, and that's how much his capital account is credited,
it. Okay,
by how much he actually invested.
thank you.
Sure. You're sure welcome. All right. All right. Now, the next one reads, Trump and Hopper have decided, Trump and Hopper have decided to contribute a depreciable asset to the partnership as his equity contribution. The following information regarding the asset is contributed. So, the historical cost is $76,000. Okay? The accumulated depreciation is $40,000. The note payable secured by the asset is $18,000. The agreed upon market value is $45,000. Based on this information, if Trump's beginning equity balance in the partnership will be, well, it'll be this minus that. And it's the same as before, it's the net. So in this case, what it is, the asset, okay, in this case, it's the market value. So here's the asset. And the asset's valued at $45,000. Minus the note payable, that the partnership agrees, of $18,000. 27 then, which is the net, goes into Trump common capital. Okay. So here's the building, here's the note, here's the net, which is the amount, and it's pretty much the same as the one before it. Any questions on that? Doing good? Okay. All right. Okay, so the next one then says Shelby and Mortensen formed a partnership with capital contributions of $300,000 and $400,000 respectively. Their partnership agreement calls for Shelby to receive $60,000 per year. Also, each partner is to receive an interest allowance of 10% of the capital beginning. The remaining income or loss is to be divided equally. If the net income from the current operations is $135,000, then Shelby and Morrison's respective shares are. All right. So again, here's the paradigm or the format or whatever it is to do this. So we're going to start out with the net income. Okay. And we have Shelby, we have Mortensen, and we have total. So the net income is $135,000. So the first thing you do is you have a salary allowance. And again, all this is has nothing to do with the salary expense. It's only a way to divvy up the net income. So Shelby gets $60,000. Okay? So this is now decreased by $60,000. Okay? Interest. All right. So 10% of $300,000 is $30,000. 10% of $400,000 is $40,000. Now $70,000 has been allocated. So if you have 60 plus 70, that comes to 130. So now $5,000 is left. It's divided equally. So this is the balance of income. And so it's divided equally, so each gets $2,500. Okay. So this plus this plus this, so Shelby gets $92,500. This plus this, and Mortensen gets $42,500. Okay. Add those two together, they should equal the net income. Does that make sense? Any questions from that? It's doing good? All right. So, Wynn invests $100,000. And Hanson invests $200,000 in a partnership. They agree. To share income and losses by allowing a $60,000 salary to Wynn, $40,000 salary to Hanson, plus an interest allowance at the beginning of capital of 10%. Under this agreement, the shares of partners when the partnership earns $105,000 are. Okay. Well, it's going to put it up here. So again, it's the same format. We're going to start out with net income. We're going to have one column for Wynn, one column for Hanson, and if we work with the total. So the net income is $105,000. All right, first there's the salary allowance. And Wynn gets $60,000, Hanson gets $40,000. So $100,000 has been distributed. Now they have an interest allowance. So 10% of Wynn's $100,000 is $10,000. 10% of Hanson's $200,000 is $20,000. So this is $30,000. Okay. Now, this plus this minus that. Now there's a deficit of $25,000 that's to be divided equally. So half of that is $12,500. $12,500. And that's balance divided equally. So this plus this minus that, so Wynn gets $57,500. This plus this minus that, Hanson gets $47,000. This plus this should equal that. Sound good? All right. Man, this is too much work. I got another one of these darn things. All right. Okay. Okay. All right. So, Juanita invested $100,000. Jacques invested $95,000 in a new partnership. They agreed to a $50,000 annual salary for Juanita, $40,000 allowance to Jacques. They also agreed to an annual interest of $10,000 beginning capital balance with the balance spread equally. Under this agreement, what are the net income and losses for the partners if their annual income is 102? Okay. All right. Have I kind of beaten the dead horse to death here? Let me check in with you guys. And look for, there's another page of this. Should I put up the answers as calculated? Would that be the best? Or how would you like me to do this? Is this,
I think this is helpful.
this is helpful? You got it. Okay, I just want to make sure we're making good use of your time.
We should put up the answers, and then if somebody has a question on one, then we should calculate it out.
Well, I think I got a request to actually walk through it. So let me walk through a couple more of these and I'll see.
Okay.
Okay.
I'll just put them on my thumbs.
Okay, it's fine. Just do it quietly. And that was been kind of. It really was. No hidden message there, just a thought, you know. All right. It's just suffering silence. So, here we have, so we'll start out with Juanita and Jacques. Okay. Now, we'll start out with the net income. And the income is $102,000, right? Now, then comes the salary. Now, Juanita gets $50,000. Jacques gets $40,000. Add them together, they equal $90,000. Okay? This means there's $12,000 left. We're going to change the format just a bit. Okay? Now we have interest. So 10% of 100,000 is 10,000. 10% of 95,000 is 9,500. Add those together, it comes to 19,500. Now we have a deficit of 7,500. We're going to divide it equally. And so half of this is 3,750. 3,750. This plus this minus that, so Juanita gets 56,250. This plus this minus that. Jacques gets 45,750. Does that sound about right?
I'm confused on this one.
By what now?
How did you get interest 10% of 52,000?
Well, right here, here's the answers that I got. So here's the answer key. So in this case, what happens in this thing is, now Juanita invested, and Chandra, make sure I'm giving you a good answer. So Juanita invested 100,000, 10% of that is 10. Jacques invested 95, 10% of that is 9,500. And can I check with you, make sure I answer my question, my answer answers your question?
Okay.
Okay.
Why does it say answers will vary?
Answer shouldn't vary.
That's what it says, answers will vary.
It does say that. Answers will vary.
We make our own
Salary.
answers.
Yeah. Yeah, creative accounting.
Will it be like that on the test?
Yeah, answers will vary, no problem. Okay, flip coin. Pick number. No, it does say that. What do you mean answers will? Unless you're saying it may have a different format.
Oh, that's probably what.
It's all it could mean, because this is accounting.
Creative accounting 202.
Creative accounting 202, exactly. All right. Okay, well, you never know. Answers will vary.
So,
I guess answers can vary, but they might not all be correct.
Well, that's, maybe that's, maybe that's what they mean. Answers can vary. Yeah, but some of them are going to be wrong.
No, I said Sam.
Okay. All right, so let's go to the next page. So now, we're gonna use this information here. So why don't I do like, so Simon and Ted are partners in a business. Simon's original capital investment, okay? By the way, guys, let me stop and think. I'm gonna end this, if I end this thing at 2, we take a 10-minute break, then we'll have an hour to take the test. That should work out. So we got 15 minutes left. And let's see, what do we have left here?
Other questions?
We do have quite a few questions. You guys, I want to make sure we get everything covered, so why don't I do this? On these, let me put this up, and we'll go through this way, and I think we can cover it. So we can cover the material, but it'll be faster if I rather than write it, I'll just point it out. So again, here's the deal. So Simon and Ted are partners in a business. Simon's original capital investment was $40,000 and Ted's was $60,000. They agree to share profits and losses as follows. So the salaries, Simon gets 12, Ted gets 18, 10% of the original investment. Remaining profits, losses, and 3/5 go to Simon, 2/5 go to Ted. So now they have a income of $50,000. So again, what will happen here is, here's the salaries, so $30,000 is distributed. Here's the 10% interest on their investment, 10. That means there's 10 left over because this is 40,000. So 3/5 of 6 goes to Simon, 2/5 of this goes to Ted. So you add them all up, 22 and 28. Does that sound good? Now the next one is a very similar one, except now there's a net income of 30. So when there's a net income of 30, again, you distribute the net as though there's a salary, as though there's a return of interest. Now, there's a deficit of 10 because 40's been distributed, but there's only 30. And then 3/5 of this, or 6,000 of the deficit comes out of Ted's, 2/5 comes out of Simon's, 2/5 or 4,000 comes out of Ted's. And this was this minus that. Does that sound about right? And I'm kind of moving along here, so this is for your benefit, so if anything's not there, I want you guys to give a yell, okay? All right? So if losses for the year are 10,000, what will be the distribution to Simon? Oh, by the way, be sure to read it carefully, because what it says, the net income for Ted is 20. Now, they ask Simon, and they ask what will the distribution of the losses be? And so what they want is, here's the loss, and so they're wanting the 14,000 for Simon. Does that sound good? So be sure to read it carefully. So this was Ted, this is Simon. Okay.
See, I would have read that different way.
Yeah.
You know, I would have read it differently too. I would have read it as this, they went to 30,000.
Yeah, me too.
What they mean though is you have this loss and it's distributed here and here. But I don't think the test is ambivalent. I'm sure it isn't. Now, okay, how do you guys do it? Should you want me to go through it, or
No.
I'd be glad to? Okay. Anybody got a question, shoot me the okay? All right. If the net income had been 15,000, what would it be to Simon? So again, here's 15,000, it goes through the exact same steps, okay? But if here's asking for, what other one asks for Simon, this says Ted, it's the same. Does that make sense? Okay. All right. So let's go on to the next one.
What was the answer for 33?
Okay,
Hey.
1,000.
Okay.
Mm-hmm. All right. Okay. The ratio is 1 to 3 to 2. That's the same as. So don't forget, the way that works is it's 1 to 3 to 2. That's 1 to 3 to 2. Add them together, they equal 6. So this is 1/6, 3/6, 2/6. So this is 1/6, 1/2, 1/3. Does that sound about right? Okay. All right. 36 is not in the book. We won't cover it. All you do is prorate it.
Okay.
Yeah, it is, it came out of an old, for some reason, the test bank came out of an old edition. And all you do is the fact that 10,000 is for 3 months, that's 3/12. This is a weighted average. So is the weighted average, is what we're doing here, is okay, 20,000 for 7 months, 7/12, and 30,000 for 2 months. So we're weighting this by this. Does that make sense? Yeah, Tim?
But one of those shouldn't be on the exam, right?
Uh-huh.
Okay.
Yeah, because my question on that was, when we done the average capital balance before, you said it was year beginning, year ending, added together, divided by 2.
In this
That
case.
does not equal
sure,
that.
Sure, sure. Now, in this case, what it is, you're weighting an average. This is if it asks for the weighted average, this is what it looks like. And it won't be on the test. Okay. All right, so using the information to answer the questions below, partners S and T each have 30,000 capital balances. So here's S's, and here's T, that's their capital balance. Okay? The cash equals 10,000, non-cash asset 100,000, liabilities are 50. Then what they do is they sell the assets for 40,000. So cash increases by 40,000, assets are reduced to 0. That means there's a loss of 60,000, and then 75% of that loss goes to Simon, and 25% goes to Ted. Everybody, any questions so far? What questions are there? All right, now, they pay off the liabilities. So in this case, this goes down by cash goes down by 50,000. The liabilities is 50,000. So now there's 15,000. So now there's no cash left because 10 plus 40 is 50,000 to the good. They spent all of it to cover the liabilities. There's none left. And Simon had 30,000, was decreased by 15, so there's a definite of 15. Ted was 30, was decreased by 15, so now it's 15. And then Simon covers his deficit, so he puts in 15,000, his are reduced to 0. And then Ted has claimed to the full 15,000, takes it and leaves town. Now, I covered a lot of material. Mariah, would you like a better explanation? Julia, would you like a better explanation? You're doing good. I just saw a quizzical look. Don't hear anything other than, I just kind of check up with you. Oh, that sound good? Michael, how you doing back there? I'm just checking if you got any questions. Gene, you doing good? All right. Levi, you doing good? All right. Okay. Now, we have 10 minutes left. Let's just, wait a second, we cover the last one now? Okay, another one does the exact same thing. Okay. If non-cash assets were sold for 50,000, each partner is personally insolvent. Partner T eventually will receive cash up. All right. So here's what we have. So again, it's the same setup. Now they sell the assets for 50,000. So now there's a $50,000 loss. 75% goes to Simon, 25% goes to Ted. So now, what we have here is they pay off the liabilities. So now, it was 60,000 in cash, paid 50, now it's down to 10. The assets have been sold, the liability has been paid off. 30 minus 3750, there's a deficit of 7,500 in Simon's. 30 minus 1250, there's still 17,500 in Ted's. Now in this case, Ted has to absorb Simon's deficit, so his capital is reduced to 10,000. That matches the cash